Hello, and welcome to another edition of Econ Updates, where we discuss what's happening in the economy and how that may affect the investment markets. I'm Steve Taddie, Chief Economist with HoyleCohen Wealth Management. Now, economic activity forecasts continue to show deceleration. Inflation data continues to moderate towards more acceptable levels. The data seems to support a Fed that has generally gotten things right. The jobs market remains in good shape, while in a lower gear, but certainly not in reverse. And GDP forecasts seem understated when you look at the strength of the employed consumers' real wage gains and the invested consumers' gains in portfolio values and income gains attributable to higher interest rates. All else being equal, one should expect GDP growth to stay in about the 2+ % range for the foreseeable future. It was the cumulative impact of incoming economic data showing a continued slowdown, plus what seems to be a more anomalistic data point from the jobs data, which showed a spike in the initial unemployment claims and a rise in the unemployment rate to 4.3%. That plus Fed inaction led people down the rabbit hole to fear a Fed-induced recession on the horizon. That created a shot across the bow in the US equity markets, more specifically focused on the Mag 7 and the other high PE growth stocks in the markets. The market has since regained its mojo as the markets bent but did not break. And as a result, the Wall Street analysts have shifted earnings per share expectations slightly, reducing 2024 earnings per share estimates and adding to 2025 earnings estimates. Part of this risk-off trade also affected US interest rates, as the flight to safety drove the interest rates on US Treasuries low, down to about the 3.7 level-ish in the US Treasury market. It has since rebounded as the economic data has come in subsequent to the height of the fears, seems to point, again, back to our earlier comments, to a Fed that is generally getting things right, and we are not going to have to contend with the Fed-induced recession. The caveat in all this for bond investors is, as the longer-term interest rates have dropped, they've rebounded a bit, but not back to levels that they were prior to the risk-off trade taking place. So even though that we expect, like most players in the market, for a Fed funds rate cut in September and in December, expectations for falling longer-term rates may not happen as expected, because some of that decline is already baked in to the bond market. Now, what to watch going forward? Stock markets are jittery, and the volatility will remain high. There's a laundry list of core economic concerns out there, but the global conflicts have gotten only hotter. And as we get deeper into the election season, the election noise will only get louder. So barring the start of a recession, expect some of these core economic issues to take a back seat for a little while longer. Use any volatility to adjust or improve your portfolios when appropriate. I thank you for taking time out of your day to tune in. I hope the rest of your day treats you well. Thank you.